What's going on, everybody? Ryan Thompson, the Assumable Guy. This is the Assumable Guy Show. Today we're tackling a question I get all the time from buyers. What happens if the home appraises for less than the purchase price on an assumable mortgage? If you've ever been worried about overpaying, this one's for you. Let's get into it. So, in a traditional purchase, the appraisal is a huge deal, right? You go under contract on a home, the lender sends out an appraiser, and if that appraised value comes in lower than your purchase price, the lender says, we're not lending you more than the home is worth. You either renegotiate the price, bring extra cash to the table, or the deal falls apart. That's the standard playbook. In an assumption, it works differently, and this is where it gets interesting. Here's what most people don't realize. When you assume a mortgage, you're not getting a brand new loan on the full purchase price. You're stepping into the seller's existing loan. That loan balance is already set. It's whatever they owe. So the appraisal doesn't affect the assumed loan at all. The bank isn't underwriting a new loan based on home value. They're just transferring the existing one into your name. Let me give you a real example. Say you're buying a home for $475,000. The seller owes $400,000 on their FHA loan at 2.375%. Your equity gap is $75,000. That's what you need to bring to the table one way or another. Now the appraiser comes back and says the home is only worth $450,000. In a traditional deal, that's a crisis. Your lender pulls back. Everyone panics. In an assumption, the $400,000 loan doesn't change, not one penny, but your equity gap is still $75,000 if you're paying the agreed purchase price. So you're essentially paying $25,000 more than the appraised value. Now I know what you're thinking. Wait, I'm overpaying for this house? That sounds terrible. And I get it. That's a totally reasonable reaction. But think about that for a second. What are you actually getting? This is where it gets real. You're getting a 2.375% interest rate. At today's rates, you'd be somewhere around 6.5%. On a $400,000 loan, that's the difference between about $1,700 a month and $2,600 a month. $900 a month in savings every single month for the next 27 years. $900 a month. That's $10,800 a year. That's a family vacation every single year. That's maxing out a Roth IRA. Over the life of that loan, you're looking at over $200,000 in interest savings. $200,000 on the same house. So let me ask you this. Would you pay a $25,000 premium to save $200,000? I would, all day long. Now here's where it gets a little more nuanced. If you're using a second mortgage to cover your equity gap, that second lender does care about the appraisal. They're lending you money based on the property value, right? So if the appraisal comes in low, the second lender might not lend you as much. That can squeeze your numbers. So what do? First, we renegotiate. I go back to the seller and say, the appraisal came in at $450,000. We need to talk about the price. A lot of sellers will work with you because they want the deal to close. Starting over means another 45 to 90 days with a new buyer. Nobody wants that. Little hack for you. Even if the seller won't drop the full amount, even a partial price reduction helps. Maybe they come down $15,000 to $460,000. Now your gap to cover just got smaller, and your second lender is happier because the LTV looks better. I had a deal where we got a 2.375% rate, and the buyer was using Climb Credit Union for a second mortgage to cover the equity gap. We also negotiated $7,000 in inspection resolution on top of that. So we're always looking for ways to reduce what you're bringing to the table. Every dollar of concessions is a dollar you don't have to come up with. And I promise you, this is where having the right team matters. I'm not just writing up the offer and hoping for the best. We're running the numbers, we're negotiating on inspections, and we're making sure the math works for you before you sign anything. Here's another thing a lot of people don't know. A lot of these homes actually don't have that much equity. Homeowners who bought in 2020 and 2021 overpaid. If it's a VA loan, they often wrapped closing fees into the loan, so they might be close to what they owe. The equity gaps on a lot of these properties are way smaller than you'd expect. Sometimes it's $15,000, $20,000. That changes the appraisal conversation completely. Now sellers, here's what this means for you. If your home appraises low and you've got a buyer trying to assume your mortgage, work with them. A $10,000 or $15,000 price adjustment is worth it when the alternative is your home sitting on the market for another 3 months and starting the assumption process from scratch. Marketing your home as assumable brings in more buyers. More competition means a stronger final price. But you've got to be flexible when the appraisal comes back. Buyers, here's the bottom line. A low appraisal on an assumption is not a deal breaker. It's a negotiation point. Run the blended rate math. If you're still saving hundreds of dollars a month compared to a conventional mortgage at 6.5%, the deal probably still makes sense. Don't let a number on a piece of paper scare you away from $200,000 in savings. I want to make this super clear. The math is what matters, not the appraisal number by itself. Do the math. Compare what you'd pay at today's rates versus what you're getting with the assumed rate. If the savings are there, the premium is worth it. It's about the math. Let's go lock in some killer rates. I'm Ryan Thompson. This is the Assumable Guy Show. If you want to see if an assumable mortgage makes sense for you, go to assumableguy.com or DM me on Instagram at the.assumable.guy. I'll run the numbers for you. No pressure, just math. Next episode, we're talking to sellers. How do you explain assumptions to your listing agent? Because most agents have never done one, and if you don't walk them through it, they're going to shut it down before you even get an offer. You don't want to miss that one. See you on the next one.